In less than 48 hours, a market that had been climbing on confidence suddenly demanded cash instead of conviction. The trigger was not a new earnings season, not a surprise speech, not a blockbuster economic release. It was plumbing. On January 31st, 2026, CME Group raised margin requirements on COMEX gold and silver futures after some of the steepest single-day plunges in decades. That single operational change mattered more than 1,000 opinions, because when margins rise into volatility, positions don't politely shrink. They are cut. At the same time, a different kind of margin system was firing at machine speed. In crypto derivatives, liquidation engines were snapping shut on leveraged trades, turning falling prices into automatic market orders. $08 billion. $5 billion as Bitcoin and major tokens sold off in unison. That is the signature of a forced exit, not a thoughtful rotation. They told people this could never happen in modern liquid markets, that deep markets absorb selling, that sophisticated risk systems prevent cascades. Yet the evidence in front of us says something else entirely. The infrastructure of markets is built to protect the clearing system, not to protect positioning. When volatility rises and collateral rules tighten, the system turns positions into cash, not months from now, not weeks, sometimes overnight. Here's the part most people miss. Forced selling doesn't arrive with a siren. It hides inside phrases like margin methodology, risk review, rebalancing, volatility targeting, and risk limits. It looks like a normal pullback until you realize the sellers are not discretionary. They're not debating valuation. They're executing a rule. And when rule-based selling becomes the dominant flow, price can move farther, faster, and more violently than fundamentals alone would justify. Welcome to Signal Ledger, where we decode what matters before it becomes the story everyone repeats afterward. If you come here for calm, data-driven context in moments when the market feels loud, you're in the right place. And if this kind of analysis helps you see structure instead of noise, consider subscribing the way you would keep a wise elder close by. Drop a comment with where you're watching from too, because market stress rarely stays local. Now let's reconstruct what actually happened, because sequence is everything. Start with silver, because silver is where leverage loves to hide. A COMEX silver futures contract represents 5,000 ounces, $44 per ounce. That's about $457,200 of notional exposure behind a single contract. Futures allow participants to control that exposure with a deposit, not with full payment, which is exactly why leverage can pile up quickly. As long as volatility stays calm, that leverage feels efficient. When volatility spikes, that leverage becomes brittle. On December 29, 2025, silver suffered a sharp intraday decline, with a reporting describing an 11% drop on COMEX. The timing matters because the move came right after CME increased the margin requirement on the March 2026 silver futures contract by about $3,000, taking the required deposit from roughly $22,000 to about $25,000 per contract. That difference sounds small until you scale it. 10 contracts requires $30,000 extra dollars. 50 contracts requires $150,000. And that cash has to appear immediately, not when it's convenient. A margin hike does one thing immediately. It turns leverage into a liquidity test. Everyone with open positions has a choice. Post more collateral or reduce exposure. In calm times, posting collateral is manageable. But margin hikes often arrive after price has already moved, which means some traders are already losing money. Posting more cash while a position is bleeding is difficult, and for some it is impossible. That is how a margin change becomes a selling event. Then, on January 13, 2026, CME changed its margin setting methodology for precious metals, moving from fixed dollar margins to margins set as a percentage of contract value. That sounds like a technical footnote, but it changes behavior in a way that matters during a surge. Fixed margins are predictable. Percentage margins scale with price and, in practice, with volatility risk. When the contract gets larger and more unstable, the collateral demand rises automatically. It makes the margin system more responsive, and it also makes it more pro-cyclical. By late January, silver had surged toward record territory, and discussion of triple-digit silver was everywhere. 1%. Put simple numbers on that. 12.1% of a $407,200 notional contract is over $55,000 in required collateral per contract. If someone was carrying 5 contracts, that is more than $250,000 tied up just to keep the position open. If the account is smaller, the position size must shrink, and shrinking is selling. Now connect that collateral pressure to daily price moves. $57 per ounce. Multiply by 5,000 ounces, and the mark-to-market swing is roughly $22,250 per contract in a single day. That means a normal-looking percentage move can consume most of a $25,000 margin deposit. And if the deposit is higher, the dollar swing is still painful because losses do not care what your initial margin was. Losses create variation margin, and variation margin is a cash settlement. This is how forced selling starts in metals. A down move creates losses. Losses create variation margin calls. Margin changes increase initial collateral needs. Some participants can post, some choose not to post, some cannot post. Positions shrink, and shrinking hits the market as sell orders. If multiple participants are in the same trade, the reduction becomes correlated. Liquidity thins, spreads widen, and price can gap. The next set of participants hits risk limits and the loop repeats. It's not personal and it's not moral. It's arithmetic. Crypto takes the same loop and compresses it into minutes. Crypto derivative venues monitor maintenance requirements continuously. When a position falls below threshold, liquidation engines close it. They do not wait for end of day. They do not negotiate. They execute. That is why liquidation totals can print in the billions without a single human choosing to sell in that moment. The exchange is enforcing solvency, $0.8 billion. That number is important, but the composition is even more important. The bulk of those liquidations were on the long side, meaning optimistic positioning was forcibly unwound. $5 billion as major tokens sold off rapidly. Whether the number is 1 billion or 2.5, the signal is the same. When liquidation totals explode, leverage is leaving the building, and it rarely leaves quietly. This is why the broad narrative of a normal pullback doesn't fit. A normal pullback is a negotiation between buyers and sellers. Forced selling is an eviction. It changes the microstructure. It changes who sets price at the margin. It changes the rhythm of markets, because forced flows do not wait for value to appear. They sell into whatever bid exists, because the bid is not the point. Cash is. Now zoom out and look at what makes this pattern so dangerous and so easy to miss. Forced selling is rarely confined to one asset. It spreads through correlation, through shared collateral, and through risk systems that treat multiple assets as one portfolio. This pattern has shown up before, and the history matters because it tells you what forced selling tends to do next. In 1987, portfolio insurance strategies were designed to reduce equity exposure as markets fell. The logic was risk management. The result was reflexivity. As prices declined, the strategy sold more, which pushed prices down further, which demanded more selling. In 1998, leverage inside long-term capital management met widening spreads and tighter funding. Once collateral demands rose, positions had to be unwound, and the unwind itself moved prices against everyone holding similar trades. The lesson was simple. The market can be forced to do something it does not want to do if the collateral rules demand it. In 2008, funding stress and margin calls forced the sale of assets that were not the original problem simply to raise cash. The story is often told as mortgages and banks, but the mechanism was collateral. When repo haircuts rise, good assets get sold to support bad ones. In 2011, silver offered a clean case study of margin-driven deleveraging. After a dramatic run-up, margin requirements were raised repeatedly within a short period, and the metal snapped lower as leveraged participants exited. The exchange did what it always does under volatility. It demanded more cash. The market responded the only way it could. It sold. In March 2020, the world watched forced selling distort even safe asset correlations. There were moments when stocks fell and treasuries also sold off. That was not a rejection of safety. It was a cash event. Funds sold what they could sell. In 2021, Archegos showed how leverage embedded in swaps can trigger forced selling in equities when a concentrated position collapses. The pattern repeats because the plumbing repeats. Leverage concentrates risk. Volatility activates risk controls. Collateral demands accelerate reductions. The reductions move price. The price move triggers more controls. In 2026, you can see the early stages of the same playbook, but scattered across venues. That fragmentation is why many viewers miss it. They look at one chart at a time. They look at one headline at a time. Forced selling is not a single story. It is a synchronized reaction across systems that share one language, collateral. So who is positioning and how can you tell? First, the exchange and clearing layer. CME does not trade direction. It manages counterparty risk. When it raises margins or changes margin methodology, it is telling you the distribution of potential price moves has widened. It is also telling you the system is prioritizing stability over speculative comfort. That matters because exchange actions can be self-reinforcing for leveraged participants. Raising the security deposit forces participants to shrink exposure, and that shrinking can move the market. Second, the brokerage and prime layer. Clearing firms can demand additional margin above the exchange minimum. They can tighten terms quickly when they see volatility and correlation risk rising across client books. That means the real collateral demand faced by participants can be greater than the headline exchange number. And when credit tightens at the intermediary level, the first participants pushed out are usually smaller and more leveraged accounts. They are removed not because their thesis is disproven, but because their liquidity is insufficient for the new regime. Third, the institutional allocation layer. Pension funds and large asset managers rebalance. Their rules are written in advance. If equities run far ahead of bonds, a balanced portfolio becomes equity heavy, and mandates require selling some equities and adding to bonds. This looks boring until you remember scale. When portfolios measured in hundreds of billions adjust, the flow is large, even if the percentage change is small. 22% in discussions of long-term positioning. When yields are elevated, bonds regain the ability to attract capital without needing a story. That changes rebalancing math. It also changes risk budgets because higher yield can reduce the pressure to chase return through equity risk. Fourth, the systematic layer. Volatility targeting strategies, risk parity approaches, and trend systems adjust exposure based on inputs, not on feelings. When realized volatility rises, volatility control strategies reduce equity exposure to maintain a target risk level. When correlations shift, risk parity reduces leverage. When trend signals roll over, managed futures can sell what they were long. These strategies can move together because they are reading the same regime shift. The result is synchronized selling that looks like a sentiment collapse, but is really a model update. Now, here's where the dislocation becomes undeniable. Two sets of signals are telling different stories at the same time. On one side, you have paper markets, where leverage is abundant and positions can be large relative to posted collateral. Futures and derivatives can swing rapidly because the marginal seller can be a forced seller. A margin change can turn an already stressed market into a cascade. A liquidation engine can turn a price slide into a waterfall. On the other side, you have the physical world, which moves slower. Around this same period, commentary on silver noted that physical buyers were facing delays obtaining metal even as futures prices whipped around. That is a paper versus physical dislocation. Paper can fall because leverage is being purged. Physical can remain tight because demand and supply chains do not reset at the speed of a margin call. There is also a psychological dislocation between official narratives and measured stress. Headlines can describe consolidation, but liquidation totals above $1 billion in a day are not consolidation. Margin changes that push collateral requirements into the tens of thousands per contract are not routine. Those are pressure valves being tightened. Now let's put the evidence on the table with numbers and context, because forced selling only sounds abstract until you quantify it. Take silver's daily math. $44 per ounce. A $1 move is $5,000 per contract. A $3 move is $15,000. A $5 move is $25,000. That is why a fast market can turn collateral into a cliff. If the contract moves against a leveraged participant, the cash required to keep the position can equal or exceed the original margin in a single day. Now take the margin framework. A fixed margin of around $25,000 feels tolerable when the market is calm. But when the system shifts toward percentage-based requirements and the margin rises toward $50,000 or $55,000, the same position size now consumes far more cash. That cash is dead weight in the sense that it cannot be used elsewhere. Funds think about opportunity cost. Traders think about liquidity. When the deposit becomes too large, they reduce exposure, and reduction is selling. Now take the liquidation engine. $1 billion of liquidations is not $1 billion of voluntary selling. It is the system closing positions. It is the system saying, your collateral is insufficient. Your position must end. When the liquidation totals are dominated by longs, it means a crowded direction is being unwound. That is why the decline can accelerate. The unwind itself becomes the catalyst. A fund losing money in crypto can sell equities to raise cash. A trader hit by silver margin calls can sell gold or sell stocks, or reduce other positions to meet requirements. Correlation is often the result of funding, not the result of shared fundamentals. This is how a pullback becomes systemic. It is not one narrative, it is one constraint. Now let's explain the mechanism in plain language, because this is where most commentary gets lost. Think of leverage as renting exposure. You put down a deposit and control something larger. As long as the market is calm, the deposit seems reasonable. But when volatility rises, the deposit requirement rises because the potential damage from price moves rises. If you cannot increase the deposit, you must reduce what you are renting. That reduction is selling. In futures, the system has two levers, initial margin and variation margin. Initial margin is the upfront deposit. Variation margin is the daily, sometimes intraday, cash settlement of gains and losses. When price moves against you, variation margin is due. If you do not pay, the position is reduced or closed. When initial margin is raised, it increases the cash you must tie up to keep the same position size. That is why margin hikes are often followed by open interest declines and price pressure. Participants are not necessarily bearish. They are constrained. In crypto, the mechanism is similar but faster. Maintenance requirements are monitored continuously. When the position falls below threshold, liquidation engines close it. Those closures hit the market as immediate orders. If the market is thin, those orders move price. If price moves, the next layer of positions hits liquidation thresholds. The engine accelerates. This is why a sharp move can cascade without a fresh piece of news. The news is the move. The move triggers the engine. The engine becomes the move. Now add institutional rules. A volatility targeting fund sees realized volatility rise. Its model says reduce exposure. That means selling. A risk parity strategy sees volatility rise and correlations increase. It reduces leverage. That means selling across assets that now contribute too much risk. A balanced fund sees equities overweight versus mandate. It sells to rebalance. None of these actors are making a statement about the future. They are executing a constraint that exists regardless of opinion. This is why the phrase forced selling signal is not dramatic. It is descriptive. It means the market is not simply trading narratives. It is clearing leverage, meeting collateral demands, and obeying risk budgets. And that dynamic can dominate price in the short run. So what does this mean going forward if the forced selling signal is here? Historically, when forced selling dominates, markets tend to overshoot in both directions. The downside overshoot comes from the cascade. The upside overshoot often comes after the cascade ends, when the absence of forced sellers creates a vacuum and prices snap back. This is why you can see violent rallies after frightening drops. The rally is not a guarantee of safety. It is the release of mechanical pressure. There are three broad paths from here, and they depend less on opinion and more on whether the plumbing stabilizes. In the conservative path, volatility cools, margins stabilize, liquidation totals normalize, and the market resumes two-way trade. In that world, the pullback can look like a sharp reset followed by rebuilding, because once the forced sellers clear, discretionary buyers can return. In the moderate path, volatility remains elevated, margins stay high, leverage stays constrained. This tends to produce choppy markets with failed rallies and sudden air pockets because participants are cautious with leverage and liquidity is inconsistent. Prices can drift lower even without terrible news because the market's capacity to absorb selling is reduced. In the aggressive path, another shock hits while the system is already tight. That could be a new volatility spike in rates, a sudden move in commodities, or a sharp equity break. In that environment, the forced selling loop can reignite because collateral demand rises again and risk systems cut exposure again. The indicators to watch are not predictions, they are gauges. Watch margin announcements and methodology changes from major exchanges. Watch liquidation totals and whether they are lopsided toward longs or shorts. Watch realized volatility because systematic strategies react to realized regimes. Watch whether physical premiums or delivery delays diverge from paper prices in metals because that signals whether paper moves are flow-driven rather than supply-driven. Watch credit conditions at intermediaries because tightening credit turns a price move into a funding move. Also watch the quiet metrics. Open interest in the contracts that just saw margin hikes, the size of daily settlement ranges, and whether bid-ask spreads widen during ordinary hours. When open interest drops while volatility stays high, leverage is leaving. When spreads widen, liquidity is disappearing. When correlations jump, risk models tighten. And now the divide. Those who understand this are not necessarily smarter. They are simply watching a different layer of the market. They are watching plumbing, not just price. They know institutions move first because constraints are written in advance. They know retail often moves last because decisions are made in the middle of the noise. And they know forced selling is the bridge between the two. Institutional constraints become market moves become headlines, and headlines become emotion. This is Signal Ledger, where we decode what matters before it's headlines. If this connected the margin moves, the liquidation prints, and the institutional constraints into one coherent picture, you know what to do. The question isn't whether markets swing. The question is whether you recognize when the swing is being pushed by choice and when it's being pulled by force.